Right now, the Magnificent Seven aren't just the biggest stocks. According to some market analysts, they're also the biggest opportunity. In this video, I'm ranking all 7 from what I believe to be worst to best based on how much money they could actually make you, and the exact prices I'd be willing to buy them at. Look guys, I've been investing for a long time, long enough to remember when Cisco was the hottest stock in the world. Guys, this is the company that was gonna be the first trillion-dollar company ever. And look at this chart. I love this chart, I love showing this. Everyone thought it was untouchable. It hit a high of $82 a share back in 2000, has not reached that high since. But here's what's interesting. Take this part out. And if people like to look at charts, how does that look? Pretty good. And guys, guess what? In this time period from 2000 to here, since its all-time high of 82, revenue is up 4.5x, profit is up 5x. But yet the stock has not hit its all-time high. Why? Because people overpaid back then for hype. And this is a company you had to have. Investors ignored price back then, and all they did was chase hype. But they're still waiting to break even over 20 years later. The Magnificent Seven right now, Apple, Microsoft, Google, Amazon, Meta, Nvidia, Tesla, they're the most talked about stocks in the world. They currently make up an egregious amount of the S&P, upwards of 40%. And Wall Street tells you that they are can't miss opportunities. But here's the truth. What matters in the long run is valuation. The price you pay versus the value you get. That's it. And I make all my investing decisions today, whether it's in real estate, stocks, businesses, based on the principle of value investing. I want to pay less than the value I'm getting. If you don't believe in that, what you're saying is you like to go to the store, see a shirt for $100 and go to the register and say, I want to pay $125 for this. There's no difference. So guys, the question becomes, how am I ranking these companies? Very simply, every investment is the present value of all future cash flow. This is the reason why we use our stock analyzer tool to sit there and say, what does the future in our opinion look like? We're going to put a low, middle, and high assumption. And I'm ranking these companies based on their potential return for the future based on today's price. Now, the great thing about the stock analyzer tool is it allows me to merge the story with the numbers. So the companies here with the best stories, I'm going to put better future potential growth in there. Why? Because they have the best stories. They have the best future potential. The ones with the worst, I'm going to put less in there. So let's dive in. Let's start with number 7, the worst company in my opinion. The one that I believe has the hardest path to delivering a strong return. And this is going to trigger a lot of people out there. Tesla. Guys, I've talked about Tesla 1,000 times on this channel. I love Tesla, the car company. I actually like Elon Musk. He's not very popular right now. And I used to say years ago, guys, be careful betting on just one person. Because all of a sudden, when he doesn't get popular anymore, the stock starts to suffer. And yes, it's at $340 a share. And the all-time high is $488 just the end of last year. But before then, guys, let's look at the 5-year chart. This is not a very sexy company. Look at this. In January of 2021, it hit a high of $294. Guys, as recent as April, we were below that number. 4 years later, and the company had grown tremendously. Now, I want to remind everybody, I'm going to go through a lot of metrics here that might feel overwhelming. If that's the case, you're not alone. I've been there, and many people watching are there right now. I'm going to try to simplify this as much as I can. Rewatch parts if you have to, because it's very important that if you understand these things, I guarantee you'll become a better investor. Now, with Tesla, everybody says it's not a car company. Guys, there's one problem. 90% of the business revenue comes from cars. Guys, let me ask you a question. If you did 100 things per day, if you treated 100 different people a certain way, and 90% of it was you being an asshole, what does that make you? It makes you an asshole. Very simple. Yes, you might do 10% of things that are very nice, but if you do 90% of the things out there in an asshole way, it makes you an asshole. If you get 90% of your revenue from the car business, what does it make your business? Makes you a car business. Now, does this mean I don't give any value to the future potential of their other businesses? Of course not. Of course I do. You have to, because every investment's the present value of all the future cash flow. But the future's unknown. We're humans, we're going to make mistakes. The problem is all this future potential is always over dramatized, in my opinion, with Tesla. For a while there, it was FSD, full self-driving software. And guess what? I was like, oh, come on, Paul, this is the future. It's full self-driving. It's the software that's going to change the world. You know how much it changed the world? They charged $12,000 for it. Not many people bought it. I said, okay, let's make it $8,000. Not many people bought it. Okay, let's make it $99 per month and we'll give 3 months free. Guess what? After the 3 months free, less than 2% of the people bought it. How is that software? Well, now it's changed. It's not about software, Paul. God, you don't get it, Paul. It's about robotics. Okay, maybe it will be. And guys, I want those humanoids when they come out. I absolutely want them. But at the end of the day, this is a car company as of right now with a future potential. But here's the issue. The car company, one metric to look at is price to sales ratio. How much you have to pay to get $1 of sales? Right now, it's at 13. Let's look at this. Let's say it's a software business. And let's say Microsoft right now, big software business, which I think is still overvalued. Guess what it's selling for? 13. When 100% of its business is software. 100% of it. So you're valuing Tesla as a software business with 100% of its revenue coming from software, even though it's not. Let's get even scarier here. Let's go look at Ford. What's their price to sales ratio? Remember, Tesla's at 13. Tesla's at 13. Ford, 0.25. That is 52 times higher. Tesla has more growth potential, but they're still selling 1.7 million cars. Okay, maybe Ford's a bad example. Let's go to Honda. Honda obviously will be much higher, right? Oh boy, 0.32. Tesla's 40 times higher. Okay, it's not Honda. Geez, Paul, you're such an idiot. It's Volkswagen. Let's go to Volkswagen. Oh no, 0.14. Oh geez, Tesla's 91 times higher than that. So guys, if that doesn't at least make you think, then I'm wondering what you're doing buying individual stocks. This should at least make you question, wait, what is going on here? Just like I question about Tesla going, okay, what would it take for Tesla to become this software business and be worth a ton of money? Now, guys, I've talked a lot about these key metrics here on a lot of companies we're going to do today. It can feel overwhelming. That's why I created this absolutely free PDF that I want you to download. Click the link below. Within 1 minute, you'll get emailed a description and explanation of all of these metrics. It's really important to have that so that we're all speaking the same language as you watch more and more videos. So here are the analyst estimates. Guys, huge growth. $1.70 per share growing to $9.65 in the next 4 or 5 years. You cannot ignore this growth. But just because there's a growth story doesn't mean you should buy at any price. Because here's what's interesting. The revenue growth numbers aren't huge. Doubling, a little over doubling in the next 4 or 5 years, which is still big, actually. I shouldn't say that. But again, is the price too high today? Well, that's why we have the stock analyzer tool. You merge all of these things together. I am going to do that right now with my assumptions. Guys, I did a 10-year analysis. And the first thing I want to do is I'm going to look at my revenue growth. What's revenue going to grow at for the next 10 years? I did 6, 12, and 18%. Now you might sit there and say, Paul, that's pretty low. Well, guys, remember, people thought by now the 2 biggest Tesla bulls, Cathie Wood, Ron Barron, I believe, actually the 3, and Meet Kevin from YouTube, said by now Tesla would be selling 5 to 10 million cars per year. Guys, they're going to struggle to sell 1.8 million this year. Just remember that the future is unknown, and when the story's awesome, people jump on the bandwagon, but you need perfection at that point. That's a reason why the stock is barely up over the last 4.5 years. Next, we're going to do profit margin. Now, guys, look. In the last 10 years, their best numbers have been about 11%. I did 7, 11, and 15%. That is high for a car company, low for a software business. So I feel like it's kind of in the middle. Let's be a little aggressive. Let's call it 10, 15, and 20%. Keep in mind that Ferrari, as a car company that has 50% gross margin, that means every car they sell, 50% of it goes to profit, while Tesla's around 18%. But Ferrari does 20% bottom line profit. They don't have a software component to it. There's a lot of potential there. But the difference is, when I put these numbers in here, it assumes day one they're making these numbers. So you need to remember that as you do this. Next, what's the PE 10 years from now? Well, currently it's 200 and the price of free cash flow is 215. So the question becomes, what's the right number? Guys, I did 15, 20, and 25 because even software businesses are 20 to 30 that are good, great businesses. So I did 15, 20, and 25, and I did my 9% desired return. This 9% return, you got to keep in mind, is for the intrinsic value. What's the company worth? Not what I'd pay for it, because you need to have a margin of safety. So I hit the analyze button. Tesla's at $340 per share. This is why I'm concerned. Assuming they make 15% free cash flow and profit margin today, $50 on the low side, $363 on the high side, $144 in the middle. As of right now, if my middle assumptions occur, which I still think are aggressive, you're looking at a negative 1% IRR on Tesla based on today. Now, stock number 6. Guys, Amazon. And Amazon, another unbelievable company that couldn't miss for a long time. But again, 5-year chart, only up 34%. And guys, take out the recent gains, it's pretty much even. You might sit there and say, well, Paul, but it's an amazing company. It is. You know how amazing it is? 5 years ago, in the flatness of the stock, went from $386 billion to $670 billion in revenue, and profit went from $21 billion to $70 billion. So everything has gotten better at the company, and guess what? The stock is still flat. That's what's incredible about fast-growing businesses, where the stock price goes up and you attach that to the stock price. But again, Amazon's an incredible business. It'll be around for a very, very long time. I love Jeff Bezos when he sat down at a panel and he said, listen, everybody's always trying to figure out what's going to change in the future. I'm not. I'm trying to figure out what's going to stay the same. And people are going to want stuff faster and cheaper forever. And he's right. And that's what he focuses on. And that's why Amazon has dominated. And guys, let's look at our analyst estimates here. $681 per share in profit, growing to $13.58. That's 2x. That's a lot. That's a lot. But if you pay too much, it doesn't matter. Remember our Cisco analysis earlier. Revenue surpassing $1 trillion here in 2029, according to analysts. Huge company. But again, if you pay too high a price, it will not work out for you. So we go to a stock analyzer tool. What is the right price to pay for Amazon? And again, I did my assumptions here. I gave them good profit margins, could be better maybe, and they are getting better overall. PE of 2023 and 26. And again, this is my intrinsic value. Pause the screen and expand to see these. But I hit the analyze button. The stock's currently at 225. I have a low price of 73, high price of 282, middle price of 150 for a 4.15% return based on my middle assumptions. Now, stock number 5. Guys, Microsoft, another incredible business. And the great part about this business is $52 a share in 2000, fell to $11 or $12 by 2011 or so. People said the company was dead. I tell this story all the time about a tech CEO telling me the company was dead after I bought shares between 17 and 21. I sold at 60 because I thought the company was overpriced. It's probably worth 50. Big mistake. Big lesson learned. Don't sell a company just because it's slightly overpriced. Let your winners run. And Microsoft was never selling for the right price for me, and it's at $500 a share now. 9.5 times more than what it was when I sold it. Boy, I wish I could take that one back. I was one of the few people buying between $17 and $21 a share. It would have been a 25x on my money. You got a $3.7 trillion company, $65 billion a year in free cash flow for the last 5 years. You've got great returns on capital. You've got great growth rate. They did a lot of acquisitions. The last 5 years, $107 billion in acquisitions that drove probably a lot of this growth rate. 14.5% revenue growth over the last 5 years. Our community members also have this company as a whole. Let's see what the analysts think about this company. Guys, they're looking at double the profit, $13.64 to $27.71. But guys, if you think this is a 20 PE company, that means 5 years from now, it's $540 a share. Guys, it's 505 right now. So based on this, not much juice left for the squeeze, but you've got great revenue growth on such a big company, 14, 15.5, 14.5, 15, 10.5, 5%, $500 billion revenue business in the next 6 or 7 years. Incredible growth potential. But what am I going to say? Does the price make sense today? That's the question. So let's pull up our stock analyzer tool on Microsoft and see if that's the case. So guys, here are my 10-year assumptions on Microsoft and our stock analyzer tool. Take a look at it. Pause the screen if you want to. I hit the analyze button. And guys, I got a low price of 240 to 280, high price of 570 to 600, middle price of 375 to 410, with a middle return of 5.3%. And that includes the dividend in all of these guys. So don't add the dividend on top of this. Guys, I just want to interrupt you, let you know about this class. We have a wonderful class that's going to enhance and teach you the foundations of investing so that these videos make even more sense to you. It's only $497, and even better, you get 3 months free of our software along with it. You get 14 sessions over an 8-week period with myself and Dalton and Mo and some other guys in the group. It's a great way to really establish yourself on the foundations and enhance it, even if you have a good, wherever you are, whether you're a beginner investor or a more advanced investor, it'll help us all speak the same language and know the same foundations. Go sign up now. Click the link in the description. Spots are limited. Thank you for your time. Guys, stock number 4. Guys, Apple's incredible. What's amazing about Apple is its price to free cash flow is around 35. Its PE ratio is 35. There was a time 10 years ago when the PE on Apple was 9, 10, or 11. And I remember somebody saying to me, Paul, from a value perspective, how does Apple look? I said, amazing. But my concern was, can they still dominate phones for that long? Because you remember 10 or 11 years ago, the iPhone has only been around for 6 or 7 years. That's very young. And the concern was, is somebody going to take them over like they took over BlackBerry? That was a concern. I thought to myself, is the juice worth the squeeze? Obviously it was, because this company's absolutely crushed it since then. This is an amazing business. It generates tons of cash flow, $100 billion a year on average in the last 5 years. Guys, the last 5-year average is $100 billion. They did $408 billion in revenue. They did $100 billion in free cash flow in the last 5 years. NVIDIA did $25 billion, and NVIDIA's market cap is higher. Well, there's more growth potential for NVIDIA, right? So that probably makes sense there. But profit margin consistently 25%. Gross margin for a hardware business, because they're changing and they're trying to get more revenue from subscriptions, which is a much higher margin. Really important to understand there. Let's look at our community members have this as a hold. That's interesting to me. Let's go to analyst estimates. $7.50 per share in profit, ending at $12.36 in the next 4 or 5 years. Growth of 10, 8, 10, 17, and 18% on earnings per share. And actually, makes sense. Revenue, 6, 5.5, 6, 5.5, 9% revenue growth. It's not going to grow a ton because it's already a huge business. So what's the business worth? Well, let's go to our stock analyzer, pull up my history on Apple. I gave them a little bit more juice on there because of the software, the subscription business being software. But here are my assumptions on Apple for the next 10 years. My 9% return. And guys, hit the analyze button. The stock's at $236. I have a low price of $120, high price of $277, middle price of $180, with a 5.77% return based on my middle assumptions. And guys, if you go back and look at our videos from years ago, this middle price keeps going up because the fundamentals keep getting better. But it doesn't mean that you should just buy it because of that. It's still important to pay the right price. Guys, stock number 3. NVIDIA, hype company, like crazy, $4.2 trillion market cap. One thing I want to remind you about how crazy this market is. This is the 1-year chart on NVIDIA. It's up 58%. But guess what, guys? It went from freaking 150 down to like 85, back up to 190, all in a 1-year period. How healthy does that sound for the largest company in the world? Now, guys, NVIDIA, no doubt about it, is a phenomenal business. It's got a great balance sheet, very little debt. This company was on the forefront of all the chips needed for AI. There is no doubt about it. I want to repeat that till I'm blue in the face because it's funny. I hear people comment to me sometimes. They'll say something as a compliment. I'm like, I never said that. We all want to hear. I'm telling you, this company is amazing. But our 5th and most important tenet of principle-driven investing is a great story can become a bad investment if you pay the wrong price. If you're just focused on the story, basically what you're saying is any price is too high. And I know you're watching this video because you don't believe that. That's what I'm trying to get across. If I can teach one thing in this video is there is too high a price to pay for even a great thing. So NVIDIA growing its cash flow. Look at this. Last year, they did $72 billion in free cash flow. In the last 5 years, the average has been $28 billion. That's almost 3 times more of the average. And that includes that, guys, incredible business. The question becomes, what does it mean for the future, though? Are they still going to grow like that? There's no way. Guys, in fact, we're already seeing metrics. They did earnings last week, and they showed, yeah, our growth is significantly slowing. Doesn't mean it's going to go to 0 or go negative, but It means that the growth, if you made growth assumptions based on the amazing performance in the last couple of years, you might be up for disappointment. Let's go see what the analysts think here. Analysts are showing not as much as I would have thought. $3 a share in profit to $7.46. That's 2.5 times, but guess what? Over a 5-year period, that's a lot, but not what it was before. You've got to remember that. What about revenue growth? 117%, 54, 25, 13, even 12%. Do you see a pattern? These are analysts, but do you see a pattern? It's getting lower. It's hard. You cannot grow a $4 trillion company at 50% per year and make a good return. It's just not possible. Now, guys, I put this company here because I focus on the stock analyzer tool. What's my potential for this company? And I pull up NVIDIA, and guys, I did my 10, 15, and 20%. You can pause the screen right now and expand it to see what my assumptions were. But when I hit the analyze button, and I made some aggressive assumptions, I feel, here's what I have. I have a low price of 73, a high price of 290, middle price of 150, which would yield me a 7.5% return based on my middle assumptions, which I still think I'm being aggressive on, to have the ample margin of safety. That's too rosy of a picture I need for me to make good money. Guys, stock number 2, Google. Incredible business, $2.8 trillion. They just got word they don't have to split off Chrome. The stock is up a lot. I don't pay attention to stock prices. I was surprised to see how high this was. Our community members have Google as a buy. But keep in mind, the stock has run up quite a bit lately. In the year to date, it's up 20%. 8% of that is just today. Great company. A little bit of acquisitions, $13.75 billion. Free cash flow, $65 billion a year. Incredible. They're showing higher net income than free cash flow, so it's an important metric to understand the difference. We don't like when we see much higher net income than free cash flow. You got to understand why that is. Very, very important. Great profit margin, increasing. 5-year profit margin of 27%. Last year, 31%. Great gross margin. A lot of positives here. Incredible business. Guys, all 7 of these businesses are incredible businesses. That's what you have to remember. Every single Magnificent 7 company is an incredible business. Let's see what analysts think about Google here. $10.23 per share, growing to $17.80, 70% increase in the next 3 or 4 years. Revenue, $406, growing to $610. Also incredible. But of course, we got to go back to our stock analyzer tool. What is this company worth to us? Here are my assumptions on Google over the next 10 years. Take a look at this. Tell me where you agree or disagree. If you're in our community, share this. Share on all these companies, because I love when I see people in the community sharing screenshots. There's a reason why our stock analyzer tool is used over 1 million times per year by our users. Now, guys, before I hit the analyze button, I want you to know that, believe it or not, 25 years ago, I was chasing hot stocks. I was following tips. I was getting caught up in the hype, hoping that one of my picks would stick. But that's not investing. That's gambling. And that's exactly why we created Everything Money. I wanted to give the 20-year-old version of me the tools, the strategy, the community I never had. So when you join Everything Money, you're not just getting our powerful investing software and our famous stock analyzer tool. You're getting a foundation. And I love when I see on Twitter people taking screenshots of our stock analyzer tool. We're going to integrate you in the community by having you watch courses that are all for free and included with your membership so that we all have the same foundation. And we get you engaged in a group of like-minded investors who want to do one thing, level up their investing so they have the right mindset and support to use our tools and increase their returns. And even more exciting, we're about to add brokerage to our platform. Now, it's not our brokerage. What we're doing is we're putting broker access. So you are the top brokerages out there. You'll be able to put your account in there and make trades from the software. We never touch your money. Companies like Schwab, Fidelity, Webull, Robinhood, all of these companies, this is the next chapter of Everything Money, and we only want serious investors to be part of it. Let me repeat that. This is not for people chasing the next shiny object. If you're not ready to follow a process, stick with it, put in the work, I don't want you to sign up. If you're committed to learning, if you're committed to investing the right way, start your 7-day trial today. Click the link below. We have limited spots each day, and we don't know how long the trial is going to stay open. But if you're serious, this is the moment. So guys, hit the analyze button on Google. Boom. I have a low price of $130, high price of $350, middle price of $216 for an 8.25% return on your money. And guys, for our number one company, here it is. Guys, Meta, another company. I bought on the way down November of 2022. I actually got lucky and my last purchase was at $88 per share, the low, and I sold at $195 because it went up too fast, and I regret that as well. This is an incredible, incredible business. It's at $735. Just goes to show you, 3 years later, the stock is up 9x, essentially. Amazing business, great metrics, increasing their cash flow. Everybody hated Zuckerberg when it was $88 a share. Now he's back to being a god again. Look at this. Very low acquisitions, $3.5 billion. Look at all this revenue growth. You know why? They haven't even tapped international for revenue, for ads. They make something like $42 per user in ads here in the US per year in revenue, but internationally it's like $4 or $5. As the world gets richer and richer, who's gonna pay off from that? Well, Meta gets WhatsApp, Instagram, Facebook, and they get 3.5 billion people out of the 8 billion in the world using their goods every single month. That's incredible. So, again, community members have it as a hold at current price. Analyst estimates, $29 per share to $45. Incredible. Good growth, double-digit growth. Revenue growth, also. I'm actually surprised that the EPS growth isn't higher. It looks like their revenue growth estimates, according to analysts, are much higher. 20, 16, 14, 13, 10%. Let's go to our stock analyzer tool. Here are my assumptions of the company. I think very reasonable. Nothing outrageous, nothing crazy. Hit the analyze button. Guys, look at this one. More green. 466 on the low, 1137 on the high, 750 in the middle, and 9.2% return based on my assumptions above in the middle row. So guys, as you can see, I just did these 7 companies. Meta was number one with only a 9.2% return. Now, some of you watching might be go, Paul, you're being too conservative in your assumptions. I probably am. But if I'm being too conservative on one of them, I'm being too conservative on all of them. But overall, the average is what? 3, 4, 5% a year based on a 10-year analysis. What does that tell you? That these companies are probably a little overpriced. Even if I'm a little conservative, it might make it 5, 6, or 7% return. Guys, you might as well buy a low-cost ETF if you're going to get those kind of returns. Don't deal with the hassle and the emotion of it all. Now, guys, early this year, I picked my own personal Magnificent Seven. 7 stocks that I own that I want to go head-to-head with this Magnificent Seven. Click the video on your screen to see which 7 stocks I picked and how they stack up. The results will absolutely surprise you because they've even surprised me. Thank you for your time.